Welcome back, everybody. Wild day. We're going to talk about what sectors to look at for tomorrow. It's not going to be what you think. But take a look at the ES today and how we held. 45.65, right in there. We are not breaking. Is support, or rather, is resistance becoming support? It sure looks that way to me. Now, a couple of things that we should deal with here. Number one, we're not even getting anywhere near here anymore. We're backing off from here. What we did see was we saw rotation today. We're going to look at a couple of the names at the end of this video and see why this rotation might actually not be the worst thing in the world and why some of these names actually look like they're already turning, the ones that just went down. But we want to talk about one sector in particular that people are definitely not paying attention to, and it's not on anyone's radar, I'm sure of it. But if you look here, so all we did was come back down and hold that level. Here's the 55. Our 55, which is what I use, not a 50. You should use what you're comfortable with, but we're pointing up. We're still pointing up. So that long-term trend is still there. Now, we have a 22.55 cross. That's irrefutable. So when we look at this, we could use the 22 and say this is for our swing trades. This is for long-term institutional positions, and everything's going well, and we have our cross. On the short term, we got right to the 12, which is what I use, and we rejected. So we rejected right off that 12. So I use a 12, a 22, and a 55. You should use what you're comfortable with. I have gone through a couple times why I use what I use. I have no problem sharing it in the future. Maybe eventually one day I'll do a video on it. But one of the things I did do on the public live pre-market call, and I would suggest that you join us. It's supposed to start at 8:30, but the guy that runs it usually starts a little late. Actually, it's supposed to start at 8:15, but we're there at 8:30 and we're there for about a half hour going through the day. So I use this pretty effectively. This is just a portion of it, but when it starts to flip to yellow, you want to pay attention. It's done a lot over the years for me as far as just giving me an understanding of what's going to happen or which way I should be looking at the market. You could see the yellow. You can see when we turn green in November. We have that little bias right here. And now we're just kind of going sideways. I'm more interested in this level, but this is really where it paid off today. So when I get a confluence of different indicators, I really want to pay attention to it. And what do I mean by that? Meaning when I get different indicators that really have no relation to one another and they start firing, I want to pay attention. And I got a bunch of that today. So I'm going to walk through this just so you can see what I mean. Number one, when this flips to yellow for me, that is bearish, or at least means that we're going to go sideways. And what did we do right here? That's where we flipped. This becomes what? The control bar. As you guys know, I like looking at control bars, guys, in the general sense. We tested that control bar right here, and we got what? We got Matumboed. Let's expand this out now that you know what we're looking at. So, and you can just see the lower highs here too, can't you? I'm sure you guys already saw that, but lower high, lower high, lower high, starts going around, start seeing it's test, 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 and what do? We break. All right, so once we start to break, we already know that we have that issue down here, and we can see this. I don't really call it a flag, just more of just a standard break. You're trying to reverse, doesn't really work, and we'll see what happens. But now we have this yellow cloud, and it's pointing down. And what we need to take into account is when it broke and when we rejected, that's where you could look at putting shorts on. At the same time, what's happening? We're pointing down the NASDAQ. So when we saw this, and I don't always use it this way, but what we were talking about in the community was this. By the way, if you're on the wait list, it's only open for another 12 hours, and then I'm shutting it down for the year as everyone gets assimilated because I speak to everybody that joins the room. I give them the opportunity. So I don't usually use this for individual names. I have other indicators, but as people like to hear, this is absolutely glaring. So turns green there, turns yellow here. It's not rocket science. And then you can kind of see how we're pointing down right there. So we talked about that in the public pre-market live, the one that was legitimately public and free. And I would suggest you listen to those videos, even if you can't make it. Put me on double speed when you're driving to work or whatever. But you can see how we're trying to lift and we're just not able to. And then if we start looking at these types of guys, this is something we want to pay attention to. But it's not everywhere. So you start looking at RTY and see how this is starting to expand. So RTY is seeing inflows. The question is how much money is going to go into small caps if tech keeps coming down? Are we going to rotate? Is that what we're going to do? So we can always look at that rotation, right? We're going to take 1 second here and look at this. I wasn't planning on doing this, but we can always just go here and just divide both by one another and kind of take a look and say, okay, well, when was the last time we were here? And all we did was take small caps and divide them by the NASDAQ. It's a great way to get a relative basis. It's okay, we see 2-month highs on this. But if we're realistic about this, it's a multi-year lows still. And so can we bounce off of that? It's really going to take a lot of time to see if that's going to work itself out. But I have a hard time believing that the IWM will ever sustainably outperform the Qs. but there will be pockets of time that's going to happen, and we're seeing one of those now. And that's giving us plenty of opportunity to find the right sectors. And by the time this video is over, you're going to know exactly what the right sectors are. So just bear with me. But when we start looking at the most obvious of indicators, to me, there is something that, I'm not going to say it again, but it is absolutely glaring. I guess I am going to say it again. So here you are at 90. So S&P stocks above the 5-day. This is free. Anyone can use this on TradingView. You don't even have to have an account. S5FD. Okay, S5FD, we look at all of these, but we're going to focus on this one. What's it telling you? 90. When you get to 90, you're setting up for a short-term pullback. It's not realistic for 90% of the S&P to be above its 5-day moving average. Now, what does this mean? It means if your stock's below the 5-day moving average, it's underperforming 90% of all stocks. See how you can do that? You don't even have to pay for a relative strength indicator. So now you know that, then you would understand why names like Nvidia, Microsoft, Apple, I'm not going to show the charts, they're underperforming. People are just avoiding them because why wouldn't you when these are going? And again, you're going to see what sectors you're supposed to be in. So this is one thing that I would take away from this video. Second thing, this is one sector that no one is paying attention to. You're not paying attention to utilities. You're paying attention to other interest rate sensitive areas, but there's one reason that you should be paying attention to this. One of the things I like to look at is corporate insider buying, and I look through the sector. And what I'm always looking for is I'm looking for anomalies. I'm looking for situations where it's off. So in this case, what I'm looking at is corporate insider buy-sell ratio, XLU. Now, this is different than corporate insider buying and selling. What it does is it takes the ratio of the two. It takes, these are your buyers, these are your sellers, and they divide and they come up with a ratio. The higher the ratio, the more buying. So in other words, the higher right here, the higher the ratio, the more selling. So they're net sellers down here and they are net buyers over the green line. Why is this sticking out to me? It's sticking out to me for a couple of reasons, but let's look exactly at what this is telling us. It's what it's calculating, because the more we know about indicators that we look, the more informed decisions we can make. So again, this is by Sentiment Trader. Long term is the time frame. It's a weekly indicator and it gets its data from Bloomberg. This shows a ratio of the total number of corporate insiders of companies covered by the XLU ETF that have bought shares in the open market during the past 6 months versus those that have sold shares. Because insiders typically only buy if they have confidence in their company and the stock will do well. Insider buying is considered stronger signal than insider selling. It's always the case. Most of them have their net worth tied up in stock, so they're always selling. That's why it's no big deal when some insider sells. If you're worth X millions of dollars and you want to actually get at the money, you may have to sell the stock. When buying picks up quickly and dramatically, it tends to be a very good sign for the stock market. So quick increases in this ratio tend to be a positive sign for stocks. Now, I don't think we can get more straight up than this. And this is what I thought was absolutely glaring, as people like to hear. And we just mark this straight across and we realize that we've only come close to this once and we're not even done going up yet. And where are we? Well, this level was right there during the pandemic, and this is where we are right now. So it's important for us to know why this is happening. When yields were dropping and yields were absolutely plummeting, anything with a yield was dropping as well. What we're seeing now is the exact opposite of that. People are chasing yield. When you could have your money in a money market account and you're earning 5%, everybody's doing it. Now, if you can't earn that 5%, you're going to have an issue. And that's exactly what we see that's happening here. So I would suggest that you take a look at some of these names that are in XLU. We've been playing them in the room for some time, but I would take a look at these. I would not sleep on these. This is not something that you're going to go out there and try and day trade contrary to popular opinion, but it's something that you're trying to get involved in and say, hey, this might not be the worst place in the world to buy dividend yielding utilities if that's something that you're interested in. Southern Company is one that we got involved in right around November, $64, $65. And the reasoning was simple. It was based upon what Pal said. We were very comfortable that was pretty much it for rates. Obviously, we didn't expect it to continue to push the way that it is. I would just watch this DTL or downward trend line, and then we'll have to see how it acts from there. But I do like this retest, pullback, rallies, can't make the lower low, and then all of a sudden we're making that higher high. That bodes well for it. All the moving averages are pointing up. But you want to look at some of the bigger ones as well. The staple is Duke Energy. You can just kind of see the DTL right here. Again, they're not the most exciting names in the world, but if you're out there trying to chase yield and you've missed the easy yield trade, which was just very simply buying treasuries, buying the high yield bond funds, and we went over those a month ago, but you're starting to see these DTLs, you're starting to see them crack. And some of these other trades that were really simple were just buying HYG when the Fed met. We actually got involved in this here, TLT, down here. We have done literally nothing with them. These are the simplest trades in the world. If you take a look at what they're going to do with interest rates, it is very clear that they're going to cut them. And they're looking at over 100 basis points right now of cuts. So the idea that this is going to drop, and that's why you're seeing the names like VNO. We went over this on Saturday. You could have, if you watch Saturday's video, that there alone was another $1.50 in this name. This is something we bought in the room exceptionally well with. SLG exceptionally well with. Where am I going with this? Okay, besides telling you the things that we're doing, everyone's looking at this. And at the time of recording this, it's a couple minutes before it wraps up on the day. Everyone's looking at NVIDIA, and I love NVIDIA, and I think it's going to be a great company. But there's a whole trade going on out there in the bond market right now, and it's interest rates, and it's all interest rate sensitive, and it's a very easy trade. And you can see how DPST is actually hitting a higher high, something we bought $10 ago. And why is this trade working? This trade's working because we understand the stool. It always comes back to the stool. Macro, fundamentals, and technical. So the macro landscape has changed. Interest rates are going down. Anyone that says that interest rates are not going down is delusional and needs to take a basic economics course at this point. And I'll show you how you can just look at one graph and see it in a second. Macro. And okay, so that's going to change the fundamental landscape of these names. Well, how's it going to change SLG, VNO, and regional banks? Lower cost of borrow. Okay? Lower cost of borrow is going to drive earnings growth in anything that is interest rate sensitive. It's just a fact. So when you see stuff like this, you want to make sure that you're getting involved with it, especially early, because once the trade's on, the trade's on. That's why I've been so adamant about this trade. And of course, once the macro shifts and the earnings shift, then what's going to shift next? The chart. And then some guy on Twitter is going to point at it and go, oh, it's breaking above this moving average. We should get in. It's already done. The trade's already over. We'll be selling to them, right? It's the same thing I tried to point out we did point out in the community today. And if you were in the pre-market live call, the public one, I was pretty blatant about this, is how we saw this coming about a month ago and bought some of this down here. I think we started getting it at 272, 472. I have to go look at the exact price, 472, 475. And so we were up 100 points today, and we know where this level is, and everyone's excited because they think Saudi Arabia or Qatar is going to come out and buy Bitcoin. Newsflash. What do we do here? Well, we sell into it. We use everyone else's, they're buying the breakout. Great. Here you go. Tag, you're it. And that entire trade is going on right now in interest rates. And this whole move in interest rates you're going to see as a major theme going in the first quarter of 2024. Here, let me show you this. Now, you've seen me use this site before, but little spot right there so you can see it. And this is CME Group. It's right here. Fed Watch is the name of the tool. Now, what is the likelihood that the Fed will change the federal target rate at upcoming FOMC meetings? This is what it's telling you. Now, this is based upon interest rate traders. Okay, fair enough. That's who I'd want to know from. Here's December. Here's our current target rate. And this is where they're suggesting that they're going to leave it. And we can go through this data. You look at 1 month, 1 week, 1 day now. I'm not going to waste an inordinate amount of time on this and go through all of these, but these are the dates that you could click on. Let's just look at this and why I'm saying what I'm saying about interest rates, why I'm talking about utilities, why this is the highest level of buying in utilities that you've seen in 20 years. All I did was click December 18th, 2024. This is a free service. Anybody can do this. What you need to learn is how to interpret the data. And it's really simple. What you would do is go, here's your current target rate. And let's leave these up here. This is your current target rate. And I really do appreciate you guys commenting on these videos, sharing these videos. I got 2 emails today from somebody that shared them. Not the same person, 2 different people. And it lets me know, like, when you say things like, hey, no, keep teaching, show more educational stuff. That is helpful. So that's why I'm actually doing this. So please keep the comments coming. Please keep the shares coming. It's why you don't see ads in the middle of this video. You're sharing the algorithm. It helps me offset the algorithm. So I appreciate it. 525, 550, that's where we're at. All right, so let's take a look at the highest degree where they have the highest probability of being in December 18th, 1 year from now. There is a 31% chance you're at 4 to 4.25. Okay, that would put you at 100 to 150 in cuts. So let's just say between 100 to 150 in cuts. You can come over here and say there's a 25% chance that you're at 375, right? And then you look at that and say, well, that puts us right in that 150 area, roughly, right? If we look at it that way, okay. You could actually say maybe even more, 175, but let's not even say that. Let's just say 150. And then let's look at this, we'll call this the high end now. Now, things can change, life changes, and we all know that. This is 100 basis points. So if I take 450 and I go straight across through all these, this is reasonable to assume that if we're at 450, we would be at 400 or lower and lower. So if you just took the 450 and and you came straight across and you added up the 20%, the 30%, you're at 50, 75%, 85%. Just throw this in, 86%. There's an 86% chance, according to right now, that you are going to be down 75 to 100 basis points in 12 months. Okay, that means that all those debt instruments are going to rally. This is why you're seeing names today like SLG explode even when the Nasdaq's down. The trade is changing, adapt or die. It's really that simple. VNO, right now they don't even have a dividend and they were trading under book value. They're just hoarding cash. Why do you think they're hoarding cash? So I'm not going to get into all this, but when I'm asked about REITs, and I was asked in the comments which REITs to look at, New York migration patterns, people are moving back to New York, period. It's a fact. And they're specifically moving back to New York City, where if you go take a look at hotel rates, they're actually higher in New York City than they were pre-pandemic. So we can say what we want, we can have any belief that we have, but I can tell you emphatically that migration patterns, which I do look at for several reasons, are going back to New York City. VNO, New York City. SLG sold 245 Park. You remember when we first started looking at this. 245 Park, they sold half of it for $2 billion. Looks like that whoever bought it, the people in Japan, actually got a fairly good deal now, doesn't it? So we're starting to see these sectors move out. So while the world is watching the stocks, I would tell you to start looking at XLE, or XLU rather, I apologize. I'm not going to edit that. XLU, XLRE, KRE. Why would you look at the regionals versus looking at XLF? You can look at both. The regionals are more interest rate sensitive because they are smaller. And based upon that, it affects their earnings greater. That's why I would focus on the regional banks more than I would focus on the JP Morgans and the Goldmans of the world. It just makes more sense. Now, you have that picture. Okay, so what does that do for us? Well, that gives us an understanding of what to do. On the short term, if you start taking a look at some of these names and we start looking at names like Tesla, I would start using a demarcation line. My demarcation line across the board is just going to be a 55 right now. And if I'm starting to wrestle this again, which I'm starting to do, it's not where I want to be. And you're seeing that wrestling going on. We are seeing that. Now, this is almost too textbook to sit there and we're just going to assume that that's going to hold. I hope it does. I truly hope it does, but it's not looking ideal. Let's look at the stocks. You did have this little doji that held today, but we're overbought. We know we're overbought in the market. So we're starting to see the big guys come in, but they're rotating and they're rotating into other names. I actually like this. I really like this because Microsoft was the first to crack. So I like this. And what I would do tomorrow is I would be watching XLK and I'd be watching Apple because the fact that you have dojis down here and you're this far off the 55, this is one of the reasons why in the room today, I just told people get a nice book and a cup of coffee. We had a lot of trades on already. A lot of trades on. So it was easy for us to sell into the rally instead of trying to add. You want to be first. You don't want to be last. And now you're starting to see the setups, but it's also why I wasn't keen on do we go out? Do we start putting on shorts? I did some shorts. I did in the video today. I shorted it, but made a couple bucks and then got out of the way when it couldn't break. Became pretty clear. But the majority of money today was MSTR. We were in and then we're getting out when we're up like $100. What do you do with these names tomorrow? I think you need to be really careful here, guys. The idea that these sovereign wealth funds that actually, just think about this from a second. These sovereign wealth funds that are in the Middle East literally have their own currency, but you think they're going to buy Bitcoin? It's absolutely delusional to think that this is what's going to happen. I'm not saying you're not going to see rallies on it, but I think you have to start using a little bit of common sense. If we start looking at something like coin, the fact that this is trading up this way, for what reason would it go up just because of Bitcoin? It makes zero sense. So this looks a little frothy to me, and that looks like that might be the end of it, frankly, when you get a doji up here. But, Bitcoin opens up another $10,000 tomorrow. Maybe it goes up higher. Other than that, you're just playing with the froth. What I would be looking for is these names like PANW. Are these things going to start holding? Are they going to start rolling? They don't look ideal right now after today, but they came a long way. Some of the other names that we're in, I think that what you should focus on are these small, little guys, like this UPST. This is something that we're in, bought at 27.28. It flipped 27.75, I think. Ripped, and now look at it. But why these? Why are these working? It all comes back again to the stool, and don't make me break out the stool again, but affirm. Why is this one going higher? Why is UPST going higher? Because their businesses are tied to what? Their businesses are tied to interest rates. That's it.